What's up guys, welcome back to the channel. In today's video I'm going to talk about exactly how I build mechanical trading strategies that actually work and don't stop working after 1 or 2 weeks. I'm going to give you the exact blueprint so you can start building your mechanical strategies as well. So without further ado, let's go to the screen behind me. Let's get started. Alright, so the first thing I want to talk about is the Edge Development Roadmap. And on the screen you can see 6 numbers, and I'm going to talk about each and every one of them because this is the process that you want to follow to build your own edge. And the first thing is going to be a solid understanding of why a market moves and a solid understanding of the characteristics of the market you want to trade. And those are the most important steps you want to focus on in the beginning. And the reason being is that a solid understanding is going to be the foundation of all the strategies that you're going to build. Because yes, you can combine all sorts of random indicators, but it doesn't really make sense. You want to build strategies that actually make sense. So when you understand how a market moves, why a market moves, what the characteristics are of the Forex market, what the characteristics are of the indices, for example, then you can really build a strategy that makes sense and that's more robust than just combining random stuff, basically. So that's going to be number 1, and I'm going to dive deeper into this later on. Number 2 is going to be learning different concepts of analysis and picking what you like. As you guys know, there are so many concepts to do analysis with. You got breakouts, you got false breakouts, trending strategies, all sorts of things, candlestick patterns, and it's totally fine. You want to do your research, but then you want to pick one of these things. Don't combine 100 of them. Pick one of these things, really study it in depth, and then basically become the master of that. So don't try to do everything at once. Pick one of these concepts, pick the one that you like, because that's going to be the easiest thing to do, and then start testing with that. Again, I will dive into it later. 3 is going to be formulating objective rules, which is going to be if this happens, then do why, because otherwise it's not a mechanical strategy. Otherwise you cannot do an objective backtest. Number 4 is going to be the initial backtesting phase, and sample size and time span are going to be really important here. Number 5 is going to be robustness testing, because a profitable backtest means absolutely nothing if it doesn't pass a robustness test, if it doesn't pass cross-market testing, if it doesn't pass adding sufficient trading costs. And number 6 is going to be possible optimization the right way, out of sample testing when needed, incubation and analysis of results, and P&L distribution. And those are the 6 things that you want to do to develop a robust trading edge. And this is what I do to develop mechanical trading systems that actually work. So let's zoom in on point number 1, which is a solid understanding of markets. And you want to learn about the characteristics of your market, but also understanding the markets in general, understanding different concepts. So this perfect graph that I made is basically just an overview of how a market moves. It tends to be quite stable for some time. Then you get a violent breakout. Then you get a stable market again, a bit of a retrace and a retest, a violent move again. And that's generally how markets move. We also want to understand why this moves, when a market is in balance, when it's not in balance, liquidity zones, order flow, absorption, what happens to when there's a lot of liquidity, what happens to the liquidity if we touch a certain area, etc, etc, etc. You want to have a solid understanding of the markets, why they move, why other markets move like this, why other markets move like that, because this is going to allow you to build multiple robust edges in the future, and it's going to give you confidence. And that's also a really important topic almost no one talks about, but even if you trade mechanical, emotions are going to come there. And the reason being is that you can still decide to skip a setup. You can still decide to switch off your system. And when your strategy is based on something solid, something that you understand, you will have more confidence in the strategy compared to when it's just a random set of indicators that you found somewhere. And that confidence is going to help you to get through the bad periods, which you will have. And that's why it's really important to understand this. So that's point number 1. And then if I zoom into point number 2, basically you don't want to be this guy, the guy that combines everything. So this week he studies this, next week he studies that, then he studies that, and then he combines it all onto a chart and he has no idea what he's looking at. This signal is going to tell him long, that one is going to tell him short. That's not what you want to do. So basically you want to take a look at what you've learned up to this point. Like all types of analysis, technical analysis, all types of trading, swing trading, day trading, breakouts, reversal, mean reversion, etc. You want to basically increase your knowledge, so really learn more about those concepts and then pick what you like and really master it. For example, I like to trade breakouts. So I studied breakouts a lot, and that's what I mastered. I'm not going to be doing breakouts today and tomorrow mean reversion, etc. because then your focus is going to be split. And if you split your focus, it's going to be very difficult to master one thing. So it's okay. In general, you want to have multiple diversified strategies, so different types of strategies, but it doesn't mean you want to build them simultaneously. So first focus on one thing, fully master breakout trading, build your edge there. Once that's finished, once it passed all the back testing, once you're trading it live without mistakes, then take a look at another form of trading. And that brings me to number 3, which is going to be objective rules. If X, then Y. And be very, very specific. So for example, people will tell me, I trade breakouts. Like a breakout is completely different. If you tell someone, like 10 people trade breakouts, every person is going to do a different type of breakout. So you need to be very specific. What's going to define a breakout for you? What's not going to define a breakout for you? What do you want to see before you enter? Where do you get out if you're wrong? Where do you get out if you're right? Be very specific and make objective rules around the concepts that you chose in point number 2, because this is going to allow you to do your initial testing, which is going to be number 4. And number 4, what I personally do is when I have my idea formulated, I will do a basic unoptimized idea. So no filters, not what if this, what if that, just a basic initial unoptimized idea from 2010 until now in a market that makes sense for the strategy. So for example, Forex is quite a ranging market. I'm not going to develop a trending strategy and start testing it randomly in all Forex markets. I prefer testing those on more trending markets. So for example, the indices or maybe the commodities. So I would test the basic idea just in one market. As you can see, this is for example a strategy in the Nasdaq that I developed. Very basic idea. Just doing the initial test, and what you want to see here is that without optimization it does make some form of returns, and it doesn't have to be perfect, and there can be drawdowns, that doesn't matter. But if your initial idea doesn't work and your profitability fully relies on you tweaking stuff, it's probably not the best. At least I wouldn't trade things like this, because I would feel like, okay, if I really have a good system, if I really have good concepts that I use for the system, it should provide some form of results, and the results shouldn't be dependent on me tweaking stuff and optimizing things. That's my personal take. Maybe you're different, maybe other people are different, but I want to see some results in the initial test before I even think about optimization. If I do my initial testing and it's not profitable, I will not continue further. I will not optimize because the foundation is not good, and therefore I'm not going to use it. So that brings me to step 5. So let's say I did my initial testing. The results are decent, not the best, but they are decent. What you then want to do is ask yourself this question. Are the results we found based on luck or based on something that's actually there? And this is really important, guys, because let's be honest, 9 out of 10 things that you're going to test are not going to work, and you're going to find a lot of things that work based on luck. So robustness testing is basically helping you to figure out, did you find something based on luck or did you find something that's actually there? And there are a few things that I personally use when I do robustness testing. These are just a few. My process is way more complex, but these are just a few. So for example, let's say you develop a strategy for the M30. You should also test the M45, and it should be profitable there as well if it's profitable on the M30. If it works on the M30 and it doesn't work on the M45, it's probably not the best. And you know, if you test the M30 and you test on the D1, for example, the daily time frame, that doesn't make any sense. Like, that's totally normal that the results will be very different because the D1 attracts different players. It's a way different time frame. But if there's, you know, you test M30 and you test M45, not that big of a difference. But if you then see the strategy just doesn't perform at all in that older time frame, it's not really robust. Same thing, if your strategy works in gold, it should also work in silver. Maybe not as good, but if your strategy works very good in gold and it just loses money in silver, it's also not a good sign. The next thing, if your strategy works with exit method X, it should also work with exit method X 1.1 and 1.2. What I mean by that is, if you have an exit method developed and you slightly tweak it, it should still make money. Even maybe it makes less money, maybe it makes a bit better. All in all, if you slightly tweak your exit method, it should make money. And the same for entry and the same for stop loss. Why? Because otherwise, in my opinion, the parameters are too sensitive. Because if it works, for example, let's say you test a strategy with a fixed RR and it works on 1 to 1.1, but it doesn't work on 1 to 1.2, you have a problem because you found something based on luck, and the slightest change in your exit method now means you don't make money. That's not a good sign as well. All in all, you want to do a lot of robustness testing to really make sure that what you found isn't based on luck and actually has an edge. And that goes more into this. And the other thing you want to ask yourself, does the idea still work after including costs? Big mistake people make is doing a backtest, not adding realistic costs, and then thinking, yes, I found something, but in reality, if you add costs, most things aren't gonna work. So that's it for robustness testing. Again, guys, be very realistic here. This is where a lot of time goes in. The initial backtesting, formulating an idea, doesn't really take that much time. The robustness testing and actually figuring out if what you found is robust, that takes a lot of time, and it should take a lot of time because this is a great test to figure out what you found is profitable or at least is doable to trade live, and most things are not going to pass this test. And that brings me to the topic of optimization, something a lot of people do wrong. And the first thing I always tell people is optimize using common sense. And that means that you only want to optimize filters, at least I only optimize things or add filters if it actually makes sense for the strategy, and I'm not going to be data mining, testing 1,000 things. Oh, this one was the best, and then picking that one, because that's just curve fitting. That's never going to work. So I also have a rule for how much filters I use, how much filters I'm able to test before I quit testing, etc. But all in all, use your common sense. If you test a strategy, doesn't really work, you add a filter, that filter didn't work, you add a new filter, it didn't work again, and you do that 10 times, you will find something that worked. But is it going to be robust? Is it going to be useful in the future? Probably not. So use your common sense there. Another rule I have is 5 decent edges without much optimization are generally better than 1 perfectly optimized edge. And a lot of people fall into the trap of finding one strategy and putting in a lot of time to making that perfect equity curve. And yes, it looks good on paper, but basically, are you building a better backtest or are you building a robust strategy that actually makes money? And you want to do the latter one and not the first one. And most people spend all the time basically building a better backtest. And that's a big pitfall of mechanical trading or systematic trading, whatever you want to call it. And what I generally do is I always say 5 decent edges are better than 1 perfect edge, and less optimization is less adapted to the past, which is more room for adaptation in the future. For example, if you tweak your settings to find the best settings for the last 5 years or so, that's highly fit to the last 5 years. And the past rhymes with the future, but it's not exactly the same. So if you fit your strategy perfectly, find the best parameters for the last 5 years, there's a very high chance these are not going to be the best settings for the next 5 years. And if you just don't, if you do a robustness test, but you're not going to cherry pick the best settings, and you don't even optimize that much at all, you leave more room for adaptation in the future. In other words, your strategy isn't perfectly fit to the past, and therefore there's more room to kind of ride with the waves of the markets, as you will. So that's really important.
use walk forward analysis if possible. This is a complex way of optimizing a strategy which uses out of sample testing. It's not useful for every strategy, but if you have a strategy that uses, indicators where you can tweak the settings, etc., walk forward optimization might be a very good thing to do, because it also is a way of optimizing, keeping your strategy up to date with the changing markets, as well as doing robustness testing. So if you want to know more about that, it's a complex topic. Just do a Google search and you'll find more information. But again, use your common sense. Some strategies I use just simply aren't doable with walk forward analysis. So it does depend on the strategy you use. Then you want to do an analysis of the results and of the P&L distribution. And this is really, really key, guys, because you want to look at the results, and first of all, you want to be happy with the results, but you also want to take a look at the P&L distribution. And what I mean by that is you don't want to be the past performance, like 80% of the past performance coming from 2 trades. That just doesn't make sense. You also don't want that when you test a 10-year period, the first 5 years were amazing, but the last 5 years it hasn't really made any money. That's also a bad sign. So you really want to add a graph there, take a look at the P&L distribution and really see, okay, the P&L distribution is quite even, and even the last few years it's still working. And that's a good sign. And then the next step is going to be incubation. So before I trade anything live, I'm first going to monitor the strategy for a few months. Just logging the results, not taking a trades, seeing in the live markets, okay, is it still profitable? Is it out of line with my backtest? Yes or no? And that's going to be really, really important as well. And that's basically the 6th step of the entire Edge development blueprint. Now, like I said, that goes more into this. I do a lot more, but I don't want to make it too complicated for you guys. So that brings me to a few golden rules. And the first golden rule is going to be, I personally test everything from 2010 up until now. And the reason I do that is, first thing is, I'm quite of a swing trader, which means I tend to hold trades from multiple positions, or for multiple days, I have to say. And the other thing is that if you develop a trending strategy, and let's say you only test 1 year, and that 1 year was a trending market, of course it will work. So you should test more. If you test from 2010 until now, you will probably have trending markets, you will have ranging markets, high volatility, low volatility, rising interest rates that go lower, a lot of different environments. And that's really key, because most people fall into the trap of developing something, testing it for 1 year in the right environment, seeing, hey, it makes money, but then when the environment changes, it loses money. And that brings me to this point. A strategy will never work in all environments. And it's a big mistake to optimize a strategy to work in all environments, because then again, you're curve fitting and it will never work. What you want to look for is that a strategy that's not blowing up during a bad environment, but then when there's a good environment, it makes money. So for example, if I go back to the graph I just showed you, this is a trending strategy. And this is over 10 years. Now, what you can see right here on the screen is that yes, it makes money in the long run, but you can also see that there are periods where it's just sideways and even a bit of a drawdown here. This was a period where the market was ranging, and this is exactly what I mean. So this is a trending strategy, and when the market is trending, like it was here, like it was here, it makes money. When the market is ranging, it goes in a bit of drawdown, but it doesn't go to shit, basically. And that's what you want to see. So again, there's no strategy that's going to work in every single environment, but when the strategy suits the right environment, you want to see it make money. And when the environment isn't right, you basically don't want to see it turn to shit. That's like bluntly saying, that's what you want to see. And then again, less is more. Are you building a better looking backtest or a better strategy? Always keep that in mind. That brings me to the last slide. This is an insight in how I build mechanical trading strategies. That goes a lot more into this. If you have any questions about this video, you can comment down below, or you can send your question to my email address and you get a personalized response from me. So let's say you're developing an edge and you don't know what to do next, or you don't know if the results are good enough to take further, whatever it is, just send me an email with your questions. I will answer them. And with that being said, thank you for watching. Hope you learned a lot. Like I said, subscribe if you haven't already. Ask me questions in the comments, whatever it is. Thank you guys for watching. Trade well, trade mechanical.